Hello, everybody, and thank you for joining us for the March edition of FrontierView's GlobalView. For those of you who are new to FrontierView, we're part of FiscoNote's Geopolitical and Market Intelligence business unit. At FrontierView, we work as a trusted partner for over 300 multinationals, supporting senior executives such as VPs of region, CFOs, and strategy leads. Our focus is empowering strategic planning, market monitoring, and international growth. And for that, we have dedicated practices for North America, Latin America, Europe, Middle East and Africa, Asia Pacific, global economics, and healthcare. We work with clients across consumer goods, healthcare, B2B, and tech sectors. And we're always aiming to help interpret what is happening in the external environment for our clients. So today's discussion is going to be quite interesting. We will be focusing on inflation and various aspects of how that is playing out. Of course, a challenge that a lot of companies faced last year, but really an open question for 2023. And I'm joined for today's conversation by Antoine Bradley, who is on our global economics team. Welcome, Antoine.
Thank you.
So I wanted to start with maybe a slightly provocative data point. We've gotten a lot of client questions on this, but we ran a benchmarking survey for clients early this year in January. And we asked them what aspect of their 2023 plan do our clients feel most uncertain about? And I think the results are quite interesting because even though that was right when plans were basically finalized and for all intents and purposes, companies needed to go into execution mode, quite a few of them, as you can see, were feeling quite uncertain around their demand assumptions. In particular, do we think demand is going to be resilient? If so, how much? And related to that is pricing as well. How many more price increases do we think we can push? At what point do we start to get real pushback from the market? And how do we think that as our pricing evolves, demand might play out relative to our expectations? So a lot of input costs still putting pressure on companies to keep raising prices. But unclear after a year and a half of extremely high inflation, how do customers, especially consumers, start to react to that? And do we start to see a dramatic drop-off in terms of spending? So nobody really has a magic answer to this question. And of course, it's product and company specific as well. But it definitely weighs on the minds of a lot of executives that we talk to. So we thought today we can dig a little deeper into the inflation story and share just a few highlights from some of the discussions that we have with our clients. So first, Antoine, talk to us a little bit about how inflation is evolving.
Yeah, so this is a chart that we use to track inflation in a wide set of countries, about 30 countries. And so this shows the proportion of countries in which the headline inflation rate, the core inflation rate, is accelerating or not. So you can kind of see the trajectory recently in the last few months and years, where during COVID it was quite low, and then at the start of 2022, the shock from after the pandemic and also from the war in Ukraine really meant that a lot of, if not at one point, almost all countries were experiencing accelerating inflation. Then towards the end of 2022, we saw a trend of falling inflation in a lot of countries, and then a majority were experiencing falling inflation. And then in the last couple of months, we're seeing maybe an acceleration again, and a lot of that has to do with the core inflation, which is either quite high or accelerating in a lot of the economies that we track.
Yeah, and this is not where you want to be after a year and a half of exactly. So, everybody is waiting for that slowdown in inflation, which is happening, but not nearly as fast as I think we would anticipate. And if we dig a little deeper into producer prices, what we see is kind of a similar trend. So they, of course, massively shot up starting in mid-2021, especially in Europe, and then really across the board in the first half of last year. Since then, they have decelerated a fair amount, but in many major markets, they're still well into the double digits. And of course, especially high in Europe, and that is energy. And those numbers are still very, very high. So that tells us something about the margin squeeze that a lot of companies are still facing, which is, of course, compelling them to keep raising prices for as long as they can, and is contributing to the sustained inflation and consumer prices as well. One exception I wanted to highlight here is China. China is different in a number of ways, but this entire global inflationary story, very, very little, if any of that, has played out in China just over the past few years and continues to be the case. In fact, producer prices contracted there in January and into late last year. And so in China, you're seeing very low CPI and then also very low producer prices, totally different operating environment. But the rest of the world is improving, but not particularly fast. And some of that, of course, is coming from the input prices the companies are facing. So, Anton, maybe you can walk us through our expectations across some of the input prices that were really driving that rally into last year.
Yeah, sure. So 2023 is, in terms of input costs, good news compared to 2022, but we're still going to see a year of really quite high input costs. So if we kind of break it down into the different ones, shipping, we've seen really a massive decline in terms of shipping costs, which were sky high levels in late 21, early 2022. The reason for that is we've seen lower demand for goods as countries exit the pandemic, so people start consuming more services relative to what they did during the pandemic. We're also seeing a slight slowdown in consumer spending, especially on big ticket items. That is reducing pressure on shipping activity, and then also just fewer COVID restrictions, especially in China, where now there's fewer ports that are being shut down. There's more air travel, which allows goods to be moved around. So again, that reduces pressure on shipping. If we look at the gas situation, that's a really important one this year, obviously, especially in Europe. Europe has been relatively okay compared to what it might have been this winter. That's been helped by warm weather and also forward planning by European countries, which really increased their stockpiles of gas and their levels of gas storage, which meant that actually they were able to sustain their levels of consumption more or less this winter. Looking forward, we think there's still quite a bit of upside risk to gas prices, especially again in Europe. They're going to have to refill their gas storages for next winter. Only this time they'll have to do it without Russian gas, which they still managed to do in 2022. So that means a bit more reliance on liquefied natural gas. Asia consumes a lot of liquefied natural gas. There's a lot of competition in that respect. That will provide some pressure to prices in 2023, especially in the second half of the year. And then finally, the big one, which is oil. We recently revised down our oil price forecast for 2023 from $92 a barrel for Brent to $88. One reason for that is that prices in the first quarter of the year were much lower than we originally expected. A lot of that has to do with recession fears. A lot of traders, etc., were expecting a recession. We see prices increasing over the course of the year. A lot of that has to do with the reopening of China, which will be a massive boost in the demand for oil. And then especially sort of in the middle of the year, we see kind of that being counterbalanced by a slowdown in the US and Europe, and then a recovery later in the year, where we expect to see the highest oil prices. On the supply side, still a tight market. The US will stop drawing down its reserves from its strategic petroleum reserves. Russia has announced that it cut some of its output. It might, cut even more this year. And OPEC has also stated its intentions to keep supply tight, obviously to keep prices high for its members.
Got it. And this is on kind of the energy side, the cost of shipping side, and we have some examples of other commodities here as well. But when we think about core inflation, some of that goes back to wages and wage growth as well. And this is a discussion we've been having increasingly because we're not seeing that uptick in unemployment that would put downward pressure on wages. In fact, wages are rising. And that gives us a sense that there are many reasons why inflation would remain relatively elevated, even with high interest rates, because it's getting baked into that core inflation. So, Antoine, can you take us a bit into the debate about the labor markets? What are we seeing there, and why is unemployment not increasing?
Yeah, well, it's one of the things that we are looking at very closely at the moment here at FrontierView, is the labor markets all around the world and the impact that can have both on consumer spending, but also on inflation. And so broadly, the situation is that labor markets around the world are still very tight, still very resilient. We're seeing unemployment at or near historical lows, multi-decade lows in major markets, in most regions around the world. Now, there's several reasons for this. One is just employers are holding their workers. They struggle to find staff in the last year or two. They don't want to get rid of them because they think we'll struggle again. They want to avoid that. Another reason is that there has been a reduction in the supply for labor since the pandemic. There's several reasons for this, and some are country specific, but reduced immigration, for example, COVID, the impact of COVID, people either being sick from COVID or dying from COVID. Some older people left the workforce, didn't return. And then in some countries, there was government stimulus, which meant household finances were relatively comfortable. That reduced some incentives of returning to work. If we look at the example of the US, just to give you a frame of reference, at this point, there are still 2 job vacancies for every unemployed person. So still a very tight labor market. And on top of that, the unemployment rate is at its lowest level in about 60 years. So, that's kind of the situation that we're in.
Yeah. And of course, that has implications also for businesses and their ability to hire.
Exactly. Yeah, absolutely. Because, that kind of takes us into this is the good news, bad news situation, and that's more the bad news situation. I mean, the good news is if we have tight labor markets, then of course that's good for consumer spending. That means we'll have a more resilient outlook. People, despite tough macroeconomic conditions such as inflation, such as lower savings, they still have a paycheck. They still go out. They still spend, and that's good news for the economy overall. The flip side of that is that if we're in a tight labor market, there are fewer workers to choose from. Employers are competing for workers. They have to offer higher wages. That translates into wage growth. Wage growth is inflationary, and that is a type of inflation which is different to the one we saw last year, and was more goods driven. That's a type of inflation that's much harder to stamp out for central banks. And so that's the dilemma that we're going to see this year in terms of central banks and in terms of the stickiness of inflation.
Excellent. And I think just to sort of provide a summary commentary on what we expect to see inflationary-wise, here we shared some of our annual average forecasts for consumer prices across a number of markets. And I think it's very clear it's coming down, but nowhere near fast enough to really get back to whatever is considered normal or expected in those markets. And so on the one side, maybe giving companies a little bit of flexibility to continue to push through on pricing. On the other hand, certainly a very tight credit cost market environment, because it's hard to envision significant cuts to interest rates in this sort of environment, especially as core inflation remains elevated. So watch the labor market if you're trying to make a judgment on inflation, is maybe the way to wrap up our conversation today. I hope this was helpful and informative to our listeners, and thank you, Antoine, for joining us today.
Thank you very much for having me.